Welcome back to the deep dive. Today we're really getting into SG Mart Ltd, looking closely at their latest results, Q2 in the first half, ending September 30, 2025. Our mission, really, is to understand this kind of dual story coming out of this major B2B player in India's construction and steel space. Because on one hand, you've got this incredibly ambitious company, riding India's economic wave, but then, boom, a pretty striking drop in quarterly profit. We need to figure out this contrast.
Yeah, it's a classic growth story puzzle, isn't it? The source material lays it out clearly. You have a company making strategic moves, shifting to higher margin services,
Yeah.
but then reporting this sharp fall in its core business EBITDA margin. Management says it's short-term stuff, but, well, we need to unpack why the financials feel so off compared to the strong volume growth.
Okay, let's maybe zoom out for a second first, because the big picture, the macro environment, that's really the bedrock of their entire story. You look at their presentation, and the numbers are just staggering. India aiming for a US $10 trillion economy by FY32. That's up from, what, about $4.18 trillion now?
Exactly. And that growth isn't just some abstract number. It's being powered by a real shift in the industrial structure. I mean, the industrial sector's contribution to GDP is projected to jump from 17% in FY25 to 31% by 2035. Think about that, a $3 trillion opportunity. It's like building a whole new economy within India.
And that demand for materials, infrastructure, it's going to be massive.
Unprecedented scale, yeah.
Which brings us straight to the problem SG Mart is tackling, this huge Indian B2B market, around $2 trillion now and growing. It's famously fragmented.
Right. Unlike, say, Japan or other industrialized places where you have these giants like Marubeni or Mitsubishi, these massive organized trading hubs, India just doesn't have that yet. SG Mart's vision to be that organized backbone, especially for crucial stuff like steel.
And steel demand is only heading up. Production forecasts are jumping from 152 million tons this year to maybe 250 million by FY30.
That kind of growth needs organized channels. Fragmented suppliers just can't handle it efficiently.
So SG Mart positions itself as the bridge, connecting the big steel producers with all the end users, construction firms, auto manufacturers, even these newer solar EPC companies.
Exactly. And their strategy tries to capture that demand, but also, crucially, manage the risks of just pure trading. That's why they've structured the business around these four core verticals. It's a deliberate shift. Phase 1 was steel-focused, simple trading. Phase 2, which we're in now, is all about adding value.
Okay, let's break those down. First, the original business, B2B metal trading. Just large volumes, hot-rolled coils, billets, that sort of thing.
Yeah, that's the foundation. It was about 30% of Q2 revenue. But look, the margins are thin, really thin. Target EBITDA is only maybe 2 to 3%. They moved 111,000 tons in Q2, which is decent volume. But the real story, the bit they're betting the future on, is the second vertical, the network of service centers.
Right, okay, this is where it gets interesting, isn't it? This is the value add part. They're not just a middleman anymore. They've got 7 centers running now, doing custom processing, cut to length, slitting.
This is what they call their operational right to win. And it addresses a real gap in the market, especially outside the big cities. Think about Tier 2, Tier 3 cities. There aren't many organized steel processors there. So end users end up paying extra freight, maybe 2% or 3% more, just to get processed steel shipped in. SG Mart aims to capture that value locally.
And the target margins reflect that. They're aiming for 4% to 5% EBITDA here, significantly higher than the trading business.
Exactly.
Yeah.
And operationally, it seems to be working. The service center volumes hit 163,000 tons in Q2.
Yeah.
That's a hefty 35% jump just from Q1.
But the utilization numbers are even more telling, right?
Absolutely. The throughput, the amount they're pushing through each center, is way higher than they initially planned for. Some locations are hitting up to 12,000 tons a month. Their initial projections were more like 5,000 to 8,000 tons, so the assets are really sweating.
Which should, in theory, lead to great operating leverage down the line.
Should, yes. Okay, then there's the diversification move. Vertical number 3, renewable structures. This is brand new, started just Q1 this fiscal year. Solar module mounting structures. Small part of revenue now, about 4% in Q2.
Yeah, but the key here is the visibility they have already. An order book of ours, 260 crores. That gives them cover for the next, 2 or 3 quarters. And crucially, they're being smart about the setup. They're using their existing service center land and sheds for the solar profiling machines. So minimal new CapEx needed for this expansion.
Smart. And the target margin there?
Targeting 2% to 4% EBITDA. So still better than basic trading.
Got it. And the last vertical, distribution products, especially the TMT bars.
Right. TMT, thermomechanically treated bars. That segment saw a strategic cleanup, actually. Back in Q4 of the last fiscal year, they shifted the TMT business to a pure royalty model. Basically, they license the brand now. It gets them out of holding inventory and tying up capital, streamlines the balance sheet. They booked about Rs 15 million in royalty income in Q2 from that. Okay, so let's recap. Strong macro story, clear strategy focused on higher margin services, assets like the service centers performing above plan, and they've cleaned up legacy bits like TMT. Operationally, seems like things are firing.
Right. The engine seems to be running hot.
But now we have to turn to the numbers that made everyone pause. The actual financials.
This is the paradox we mentioned up front. If service center volume is rocketing up 35% quarter on quarter, how did that not translate to the bottom line? It feels counterintuitive.
Let's lay out the Q2 consolidated figures. Net revenue, Rs 17,042 million. That's a really strong 49% jump from Q1.
Impressive QOQ growth, yeah.
But then you look at profit. Net profit actually dropped 18% from Q1, down to Rs 265 million. And the big one, business EBITDA, fell sharply to Rs 280 million from Rs 359 million in Q1.
And that translates directly to the margin collapse. The business EBITDA margin fell about 150 basis points, landing at just 1.6% for the quarter, down from 3.1% in Q1.
Ouch. So what's the explanation? Management points to three specific things, calling them short-term issues.
Okay, let's unpack those. Reason one, steel price volatility. Apparently, steel prices fell by roughly nice 3,000 per ton during the quarter. Now, SG Mart tries to keep inventory lean, about 27 days worth, but a sharp, fast drop like that still means inventory losses had to be booked.
Hold on, though. Wasn't the whole point of pushing into service centers, that higher margin value-add segment, supposed to insulate them from these commodity price swings?
Well, yes, that's the long-term goal.
But if the inventory losses hit them primarily through the service center inventory, as management clarified, doesn't that kind of undermine the strategy's effectiveness, at least right now?
It definitely shows the insulation isn't total, not yet, anyway. You see, even with processing, there's a lead time. They have to hold some inventory. So when prices plummet quickly, the loss gets booked against the segment holding the stock. It shows that until those processing volumes get even bigger relative to trading, they're still somewhat exposed. The strategy needs more scale to fully work as intended against price drops.
Okay, fair point. It's not fully insulated yet. What was reason number 2 for the margin hit? This one sounds more strategic.
Right. Reason 2 was a deliberate choice, the branding expense cleanup. They decided to take a hit now by booking a large chunk of branding and marketing costs in Q2 and Q3. These were costs they originally planned to spread out, amortize over 24 months.
Okay. So they're pulling future expenses forward, depressing current earnings on purpose. Why do that? Why take that pain now?
It's all about the quality of their future earnings reports. Think about it from an analyst or investor perspective. By getting these non-recurring planned future expenses out of the way now, they create a clean slate for the P&L starting in Q4. It means future results should reflect the true underlying operational profitability without being dragged down by old amortization schedules. Investors often prefer cleaner, more predictable earnings.
Okay, that makes sense. Short-term pain for long-term transparency. An investment in credibility, basically. And the third factor.
Reason 3 was simpler. New business fixed costs. The new renewable structure segment, even using existing sheds, still had startup costs. Marketing, initial manufacturing setup, operational hires, those costs had to be absorbed as the business ramped up in Q2.
Right, standard startup drag. So looking ahead, management is basically saying Q3 might look similar to Q2 because they're continuing this expense cleanup.
Yeah, Q3 is still part of the cleanup phase.
Which makes Q4 the real test. That's when we should theoretically see the true profitability emerge, assuming steel prices stabilize and the cleanup is done.
And this context explains the guidance shift. They originally targeted Rs 200 crores in EBITDA for this full fiscal year, FY26. Now they're saying that's difficult to achieve.
Difficult to achieve. We have to wonder how much of that is market conditions versus how much is them resetting expectations after taking this big voluntary expense hit.
It's probably a mix. But they were quick to reiterate their long-term target, that 25% return on capital employed. They're still aiming for that, banking on the service centers and renewables, scaling up and delivering those higher, more stable margins.
And amidst all this margin noise, some operational metrics did look better, right? Working capital.
Yeah, net working capital days actually improved quite a bit, down to 22 days for the first half compared to 30 days for all of last year. Shows better cash management. It ticked up slightly from Q1, they said, due to inventory for the new renewables business and some international trading, but still efficient overall.
And the balance sheet looks incredibly strong now. Debt came way down.
Massively down from nearly Rs 7 billion at the end of FY25 to just Rs. 2.3 billion at the end of September. That's a huge deleveraging.
Wow.
And connect that to the cash position. They're sitting on Rs. 8.5 billion in net cash. That gives them enormous firepower for expansion, acquisitions, whatever strategic moves they want to make without relying on shaky capital markets.
Which ties back to their strategy, right? Become less vulnerable to those big steel price swings we talked about.
Absolutely. The clear focus going forward is on those businesses with higher, more stable spreads, service centers, renewable structures, anything involving semi-processing or light manufacturing. That's the structural shift needed to get away from pure commodity trading volatility and deliver consistent margins. And meanwhile, the platform keeps growing, over 2,300 customers, 400 vendors registered now.
Okay, so let's try and wrap this up. What we're seeing with SG Mart is a company in a massive growth sector, making a very deliberate pivot towards higher margin, value-added services. They took a big hit on profitability in Q2, yes, partly due to market volatility, but also significantly due to an internal, strategic choice cleaning up expenses now for cleaner earnings later.
Exactly. The long-term success now really hinges on execution.
Right.
Can they successfully expand geographically? They mentioned Jaipur coming online in Q4, plans for East and South India. And can they maintain or even increase that high throughput in existing centers to consistently hit that target 4 or 5% service center margin? That's what's needed to truly buffer against the commodity risk.
Which brings us to a final thought for you, the listener, to chew on. Management highlighted that throughput per center is already beating expectations, sometimes hitting 12,000 tons a month. Now, given that success and sitting on that huge pile of cash, Rs. 8.5 billion, the strategic question becomes, what's the best use of that capital right now? Should they double down on maximizing efficiency and throughput at the existing 7 centers to prove out that 4-5% margin model quickly? Or should they aggressively chase geographic expansion, aiming for that 4 to 7 new centers per year goal, even if finding and integrating acquisitions takes time and resources? Which path gets them to that promised 25% ROCE faster and more reliably? Something to consider. Thanks for joining us for the deep dive. We'll catch you next time.